Are you aware that millions of property owners navigate the complexities of reporting rental income on their tax returns each year? That's a lot of people dealing with rental properties. Reporting rental income correctly is important for these property owners to stay on the right side of tax laws. In this video, we'll dive into everything you need to know about rental income, what it includes, how to report it, and tips to make sure you're doing it correctly. Let's get started on this journey to demystify rental income on your taxes. Don't forget to hit the like button, subscribe for more insightful content, and share this video with friends who could benefit from this information. Your engagement helps us reach and assist more people navigating their tax responsibilities. What is rental income? Imagine you have an extra house or even just a spare room. You aren't using it, but someone else might need a place to live or work. You therefore decide to rent it out. The income that you make from renting out that extra space is known as rental income. Rental income is the money you earn by letting someone else use your property. It's like a payment they make for borrowing your space. Here's how it works. You are the landlord. You own the property, the house, apartment, room, or land, and there is a tenant. He is known as the person who uses your property and pays you rent is your tenant. Usually, you and your tenant sign a contract. This says how long they'll stay, how much rent they'll pay, and other rules. The rent is the regular payment your tenant makes, usually every month. There could be several types of rental income. 1. Regular rentals, also known as long-term rentals. This is like renting out a whole house or apartment to someone who wants to live there for a long time, usually a year or more. They sign a paper agreeing to stay for a while and pay you rent each month. It's the same amount every time, so it's easy for you to plan. Imagine your friend needs a place to live for a year while they go to school. You have an empty apartment. That's a perfect regular rental setup. 2. Short-term rentals, like renting out a room in your house or the whole place for just a few nights at a time. Think of websites like Airbnb and VRBO that help you with this. Travelers or people who need a place for a little while find your rental online. They stay, pay you, and then leave. You might have different people staying each week. Example, your city is having a big festival, and lots of visitors need a place to sleep. Renting out your spare bedroom on Airbnb is known as a short-term rental. 3. Business rentals. Instead of renting for people to live in, you rent to businesses. These are known as business rentals. A store might want to rent a space in a shopping center, or a company might need an office to work from. Example, you own a small building with empty shop spaces. Renting one out to a bakery is a business rental. Let us talk about some of the common deductible expenses that landlords can take. Remember, as a landlord, you can subtract a lot of the costs of running your rental from the income you earn. This lowers the amount of tax you have to pay. Here's a list of the most common things you can deduct. Fixtures and maintenance. Money spent on fixing things to keep the property in good condition can be deducted. This includes repairs like fixing leaks, painting, or replacing broken windows. Property taxes. Every year, the government charges you a fee for owning your property. You can deduct this whole amount. Insurance. Landlord insurance is special protection for rental properties. It covers things like fires, storms, or even if a tenant sues you. The cost of this insurance is deductible. Utilities, though sometimes only. If you pay for the electricity, water, or heating for your rental, these costs can often be deducted. But if your tenant pays their own utilities, you can't deduct them. Mortgage interest payments. If you have a loan on your rental property, the interest you pay on that loan is deductible. This helps reduce the cost of borrowing money. Operating expenses. The everyday costs of running your rental property can be deducted. This includes things like utility bills, property management fees, and advertising costs for finding new tenants. Where to report rental income on your taxes. You'll use Schedule E, Part 1, to list your rental income and expenses. This form is attached to your Form 1040 or 1040 SR, which is your main tax return form. What do you include on Schedule E? On Schedule E, you'll write down how much money you made from rent, and then subtract the expenses related to your rental property. Expenses can include things like repairs, mortgage interest, property taxes, and insurance. After listing your income and expenses, you'll see if you made a profit or had a loss. This total goes on your main tax form, Form 1040 or 1040 SR. You would also need to use Form 4562 for depreciation purposes. Why depreciation matters. Depreciation lets you spread out the cost of your property, except for the land, and big purchases for the property over their useful life. It's a way to deduct these costs over many years. How to report depreciation. You use Form 4562 to calculate and report depreciation. This includes the building itself and any major improvements or addition. Let's talk about the two accounting methods, cash versus accrual, that are commonly used. When you earn money from renting out property, how you report this income and expenses to the tax authorities depends on the accounting method you choose, cash or accrual. Here's a simple breakdown of each method. 1. Cash method. Timing. With the cash method, you report rental income in the year you actually receive it, no matter when it was earned. For example, if a tenant pays their December rent in January, you report that income for January. Expenses. Similarly, you deduct expenses in the year you pay them. If you pay for repairs in December, you deduct those expenses in December, even if the repairs were done in November. 2. Accrual method. Timing. The accrual method is different. Here, you report income when you earn it, not when you receive it. So, if you earned rent in December but didn't get paid until January, you still report that income for December. Expenses. For expenses, it's also about when you incur them, not when you pay. If you got a bill for repairs in December but paid it in January, you'd still deduct the expense in December. Now let us discuss the impact of each of those two methods on rental income and expenses. Cash method. This is simpler for most people. It means you only need to think about what money actually came in or went out during the tax year. It's straightforward and matches how most people manage their personal finances. Accrual method. This method can help or hurt, depending on when money moves. It might make your income look higher in one year if you earn a lot, but don't receive it until the next year. However, it can also let you deduct expenses sooner. There is something else that you need to know. That is about limitations on losses. When you rent out property, sometimes the money you spend, also known as expenses, is more than the money you make, which is your income. This situation is called a loss. However, there are rules about how much of this loss you can use to lower your taxes. These rules are called passive activity loss rules and at-risk rules. Let's break them down in simple terms. What are passive activity loss rules? These rules limit the amount of loss you can deduct from other income, like your salary or business income, if your rental activity is considered passive. What is passive activity? If you don't materially participate in managing the property, it's considered passive. Basically, if you're not involved in the day-to-day operations, it's a passive activity. What are passive activity limitations, therefore? The rules can limit your loss deductions to the amount of income you make from passive activities. If your losses are more than your income, you might not be able to deduct the extra loss right away. Why do these limitations matter? They matter because of fairness and prevention of abuse. These rules were created to prevent people from using rental losses to significantly lower their taxes in ways that weren't intended by the law. Carryover. If you can't deduct all your losses in one year because of these rules, you might be able to carry over the loss to the next year and deduct it then, depending on your situation. The key takeaway is to understand what income you need to report, track your expenses carefully, and use the right forms. Don't forget, state taxes might have their own rules for rental income too. If things get too complicated, don't stress. A tax professional can make sure you get all the possible deductions and avoid any mistakes. Being a landlord takes work, but those tax benefits are a nice reward. If you found this video helpful, please give it a thumbs up, subscribe to the channel, and let me know in the comments what other tax-related topics you'd like me to cover. Until next time, happy renting!